important that I guess we're aware, everybody's aware that we are across all these things that are happening in the marketplace. So what I'd like to do now, and of course this particular webinar has been done especially for the regional markets in New South Wales, because we do understand that it is quite often difficult for you guys and girls to get into our normal PD days. So what we're seeing here is our presentation of what we normally do in the metro areas for our professional development days. Now, I'm not going to go through everything that you can see in front of you on the screen there, but I do want to touch on some highlights. So let's have a look at a couple of those, and I'll discuss those in more detail. Rightio. So you've all hopefully heard about the Combined Industry Forum, and that is actually a very unique body, if you like, that has grown out of the ASIC's remuneration review into mortgage broking home loan commissions. And for the very first time in our industry, and this is my 40th year in the game, that the industry has actually collectively got together to ensure that we can get a detailed and accurate response back into government in relationship to what's happening with commissions and how they're paid to brokers. And there's an extensive amount of work being done there, and there is some very good traction to the point that both ASIC and Treasury have been very supportive of what the Combined Industry Forum has been doing, and have actually made recommendations back into government supporting the moves that the Combined Industry Forum's been undertaking. Now, I know not everything makes us all happy. The Combined Industry Forum has moved on to get rid of soft dollar commissions and volume bonuses, is something that ASIC made a very significant point across that needed to be done. And then ASIC, the ASA, came out and said, well, we want to see commissions tweaked. We think it could be done a little bit better for various reasons that they found in their research. Whether we agree with that or not, I can tell you now some of their research I don't agree with. It was incomplete to the thoroughness and completion of to where it should be. But nonetheless, excuse me, they believed that commissions needed to be tweaked, and industry stepped up and said, okay, well, we'll do it. We'll tweak commission so it's net of offset and net of undrawn amounts. Now, there's various arguments around that, but the thing that's critical to understand is that if industry doesn't take a preemptive move on things like this, then a politician is going to make the decisions for us, and that would not be a good outcome. I remember back when it was first announced in late 2015 by the Federal Minister, Kelly O'Dwyer, that she was going to direct ASIC to have this inquiry, this research done on brokers' commissions. And I went and met with her in the December. I had a breakfast meeting in her office in the December of 2015. And I can tell you now the discussion we had was not something that we would all favour. And it's better off that we take some preemptive moves rather than letting a politician make the decision for us, because their real mission in life is to make sure they've got a job when the next comes around for election periods. And quite often those decisions can be tarnished. So the work the Combined Industry Forum is doing is extremely important. Let's have a look at something else. Now with the AVCA. Although a little bit of this is past tense now, but I think it's important we all understand a couple of things. Now obviously AVCA is the combination of three ombudsman systems. So that was FOS, CIO, and what was this Superannuation Guarantee Tribunal. We won't worry about the Superannuation Guarantee Tribunal. It's not in the dead area. But between CIO and FOS, they came together as one, and that new regime starts at the beginning of next month. Now, for those of you that were FOS members, you basically ticked the box, paid your normal membership fee, and the world was all good. Unfortunately for CIO people, it wasn't quite that way. They have wound up having to pay two lots of fees. Now, unfortunately, even though we argued it even with the regulator ASIC, and ASIC has given some concessions since those discussions, hasn't changed the fact that CIO members have had to pay two lots of fees. We don't agree with it. We didn't agree with it right from the beginning. And unfortunately, from my personal point of view, so what I'm going to say is not an FBAA's viewpoint, it's Peter White's viewpoint, is to me it was a management system failure within CIO. They did not prepare and manage their business properly for the runoff through the transition period with them combining with AFCA. So basically the money that people are paying now, or the extra money that people are paying now to CIO, actually creates a cash flow for the final administration work for the next 12 months for any complaints. With FOS, they'd already provisioned that, so it wasn't actually a situation for them. Unfortunately, as far as I'm concerned, it disadvantages the CIO members. There is nothing we can do about it, unfortunately, and we have taken it to the highest levels we can. So we have to manage through that. CIO and in conjunction with AFCA have said, well, technically it's not a not-for-profit style situation, so if there are any surplus funds in 12 months, then it needs to be passed back to the members, that's the CIO members. My gut feel says, don't hold your breath for it. We'll just need to manage through the way it is. The only concession, if it's a concession at all, and I don't say this flippantly, but it is a tax write-off. So I guess that's the only upside, if there is one anywhere. So anyhow, AFCA commences next month. They have a formal launch next Friday, which I will be at down in Melbourne, and we will move forward into that new world as we go forward. Let's have a look at what's happening with the funding of enforcement costs and their ASIC's enforcement costs back to industry. So Treasury, as a quick background, Treasury came out in 2016 and advised that the annual renewal fee for a licence needed to be changed. That model needed to be changed. So those of you who are ACL holders, you would be paying a fee anywhere from about, even money, $420 a year to $30,000 a year, depending on volumes. And that money is used to offset the enforcement costs of ASIC back to industry. That's what the funding's all about. And that's not uncommon anywhere in the world from a regulatory point of view. The enforcement costs to any industry get pushed back to industry. So it was their issues in the first place. And in 2016, we were given a whole lot of data from Treasury, who are introducing this, saying that the enforcement costs to the broking sector alone, so not financial planners, not insurers, not bankers or anyone else, purely for mortgage brokers in this, consumer brokers in the country, we're sitting at $16.5 million. They gave us a whole lot of data to look at. We reviewed it and went back to them in February of 2017 and said, well, wait a second, these aren't our costs. Not this one, not this one, not this one. They had a review of that and said, oh, good news, the bill's come down to $10.6 million. So we should have. They were leveraging us with our sector with a whole lot of costs that shouldn't have been there. So the FBAA managed to get that knocked back somewhere around 30% compared to what it was going to be. And what that basically resulted at, that going forward, the annual renewal cost for a credit license was going to be $1,000. But then in addition to that, there would be costs for every credit representative under the ACL holder of $170 per credit rep. So $1,000 for the license, $170 for the credit rep. And that was the model to go forward. And that would then cover the enforcement costs to ASIC. As we got, it was probably about 4 or 5 months ago now, ASIC came out to us as it transitioned out of Treasury into ASIC, ASIC's control. ASIC said, well, the enforcement costs actually for the last 4 months come down. It's now just under $9.1 million. And as a consequence of that, we can reduce the cost for renewals. The cost, unfortunately, to the license holder is unchanged. It's $1,000. But for every credit representative, it's $104. So that's the reason for that is the regulator is a quasi not-for-profit, a bit like the Ombudsman. They cannot collect more revenue than what they've expensed in this particular part. So we're not paying for their administration or their business costs. This is purely for enforcement costs. So they cannot collect more than what they've expended. So if the bill's 9.1, they can only collect 9.1. Or if the bill's 16.5, then they can collect 16.5. If the bill's 5, they can only collect 5 mil. So that's the way it finished off. And what will happen, and this commences from invoicing from ASIC from the beginning of next year, is the credit license holder will receive a bill for their $1,000 together with a bill of $104 for every credit rep that sits underneath them, and the licensee will push that back to the credit rep to pay, and then it'll all push back up into the system through to ASIC. And that's the fair way to, I guess, meet those costs. Because unfortunately, whether we like it or not, at the end of the day, when you look at ASIC's enforcements, the vast majority of enforcements are against credit representatives. So it puts it back on us, I guess, to industry and to license holders and to aggregators to make sure that we constantly audit and monitor our activities to make sure we minimise what those enforcement costs can be. Because the better the results that we have, the more those figures will come down. So it only acts to benefit us. But conversely, if we don't monitor and audit ourselves properly and that bill goes up, well, so does the cost of an ACL and an ACR. So we need to keep abreast of that. But that basically is what's happening and starts from the invoices that will start to go out from ASIC commencing 2019. The other thing I'd like to talk to you about is what's happening with credit card reforms. And I don't know how many of you are actually across it, but there are some significant changes happening in this area. Now, we've known for a very long time the old maths that sits behind how we treat credit cards when we're looking at serviceability of a loan. It was a percentage of the limit as the minimum repayment. It used to be 3%. I'm not sure if it went up to 5%, but it was sitting around that sort of mark. And that's all changing. It was a part of reforms that were started to be talked about a couple of years ago when government were concerned that we were in such a low interest rate environment for a long time. What happens when interest rate goes up? What potential hardships are there going to be? And when they looked at credit cards, we found that Australians were amongst the highest per capita in the world as far as usage of credit card goes, and the majority of debt is carried, not paid out every month. So some real concerns there as rates go up and the pressure starts to apply financially on people. Where will the cracks appear? And there's obviously a warning bell against credit cards. But without going through all the details, and we've been in constant negotiations with the regulators and submission papers and so on since that time, ASIC has landed on a position where they believe, or they have put through from a regulatory point of view, how servicing will be equated as we go forward. That servicing is based on these maths. So when we're doing an expenditure analysis of a person's application and they've got a credit card, you'll need to take the limit multiplied by the highest interest rate in the marketplace plus 2% on a principal and interest basis over 3 years. So P&I, 3 years, on an interest rate in today's market that would be 24%. The highest card in the market is around 22, at 2 on that, that's 24%, based on the limit, not on usage. Now that's a significant change to where we are today and has huge implications as we go forward. Some of those implications are that, well, people will be going for a loan and they might have 5 credit cards, and all of a sudden, oh, sorry, I can't help you out with that loan because you actually don't meet serviceability requirements. But on 2 credit cards, you do. And in a hypothetical situation, if you had 5 cards, you only use 1, but you service on 2, you could then cancel by the way regulation's been changed. You can cancel those cards online and write the loan. So they go from 5 credit cards to having 2, and they only use 1, so they've still got a buffer. Or alternatively, and again hypothetically, somebody might have a $60,000 limit. They don't service on a $60,000 limit. They service on a 20, and they only ever use about $5,000 a month on their credit card. So they've got a $15,000 buffer. You can reduce online the limit from that 60 down to 20. Do the loan. Everybody's happy. The only problem there is what happens in the retail environment. And I was at the invite of the Senate at the handing down of the budget this year, which I go to each year, and I was sitting next to a guy called Russell Zimmerman, who is my equivalent in the Australian Retailers Association, and I just asked him casually, how are they going with the change in credit card legislation? And he turned and looked at me and said, well, what the hell are you going on about? I said, what, you don't know? And they did. They obviously did. So we had a discussion around that. He was very unimpressed. We had several meetings together. Submissions were closing. Well, they actually wrote a letter of support to the FBAA submission on where we believe that these things should change. And it went forward from there. Now, ASIC have made this determination based on some research they did. And their research said that 72% of the credit card market, or the people having credit cards, have only one card with a $6,000 limit. Now, I don't know how many of you who are listening here on this right now have clients that have only got one credit card with a $6,000 limit, but I asked this question all around the country, and so far I've only just scratched about 1% of the people I've spoken to, and I'm talking 4,000 or 5,000 brokers I've spoken to since, that I have clients with one credit card of no more than $6,000. It's always much more than that. So we have questioned their data. We've questioned their determination. ASIC have come back and said, well, we looked at the UK model, and over in UK this is how they dealt with it. That may be all well and good, but 72% of the market, the credit card market, we don't see anywhere near that sort of situation where the people got one card with $6,000 limit. Which, if it was the case that the vast majority of people had one card with $6,000 limit, then equating serviceability on a principal interest basis over 3 years at 24% probably isn't completely unreasonable. And remember, we're talking serviceability. They don't actually have to make those payments, but they've got to qualify to be able to do that. So that's probably not completely unreasonable, but we strongly feel that that's not the case. And from the Australian Retailers Association, if we start reducing limits or reducing cards so that people can get their home loan or a motor vehicle loan or whatever, what happens at spending at Christmas? I mean, people use their cards to buy Christmas presents and so on, and at peak times through the year, go on key holidays, and then pay it off or gradually pay it off. That's going to reduce retail spending. And I was fortunate to be at a small group lunch with Josh Frydenberg, our new Federal Treasurer. And I was talking to him about this because my greatest concern is that there will be significant impact to the Australian retail economy with what could happen at the back end of this due to poor regulation that's put out through ASIC. And he agreed and is concerned about it. So we're now dealing with the Federal Treasurer's senior advisor himself in regards to what ASIC have done, because the Treasurer is the boss of ASIC, and we're going through the motion to see if we can't get some modification on it. Now, we can make no guarantees, and if nothing changes from what we know today, come the beginning of January 2019, these are the new rules for servicing going forward. We all need to be across it. We are rather unhappy, to say the least, in regards to this, but we're doing all we can to see if we can get some change to it, but we'll have to wait and see how we go forward from there. That's what's happening on the credit card side. It's a significant impact to what's happening in the marketplace, so we need to be across it. Hopefully you'll hear more from your lenders as we get closer to that date. They really should be talking to you now. A couple of other pieces, I guess, on the ASIC front they're conducting right at this time is an application loan fraud analysis, and they've called for data from lenders and aggregators and the like to review what's happening. And they originally were going to have this done by the end of the third quarter, but they got caught up with what was happening with the Productivity Commission and the Royal Commission, so they're delayed on what they had proposed that they were going to do. And now my understanding is that by the middle of next year, this consultation period should be finished and information known. Maybe in the first quarter of next year, but I guess they might be pushed out a little bit because they've also been doing the shadow shopping, and I know that they expect to have a report on the shadow shopping out by the middle of next year. So I think there might be a little bit of congestion there as they get to that point in time. That's happening there. And also, whilst I'm just going through this, just as a reminder, don't forget, if you've got any questions, I'll be answering them at the end, and use the little question bubble at the top of your screen to be able to submit those questions, and I'll get to many as I can once we get to the end. So let's move forward from there. The other piece that ASIC is doing is a complete review of RG 209 responsible lending obligations. And again, that got a late start due to the Royal Commission and Productivity Commission, and that's probably a good 12 months or more's work. I remember when ASIC first spoke to me that this was going to be done, they spoke to me in the language as what they did when they were looking at doing the review of brokers' remunerations into home loan commissions. And that was, we know, dragged out to about a 15-month piece of work. And I expect that this is probably going to be something very similar. Because once they first started that, they also then expanded it into doing a review of responsible lending in the motor sector. And I've spent a lot of time in that game back in the old days. And I can see there's a lot of work to be done there as well. So given that regulation was put together around 10 years ago, in 2007 and heading into 2008, I was sitting on the consultation committee for Treasury, bringing the regulation in and framing it. So it was done a while ago, and it's appropriate that it gets looked at to see if it's still relevant or where the issues are, concerns are, or whether it still meets the need. I would dare say it doesn't, and so there'll be a fair bit of work done to upgrade that. And there'll be industry consultation on that as it goes forward, but they need to start and frame their initial thoughts and reviews upon that. The other thing I want to talk about is HEM, the Household Expenditure Measure. And I've touched a couple of times on Royal Commission, Productivity Commissions, and I'll speak a bit more about that at the moment. And there's 1,000,001 questions that we can come up with on HEM. And I guess it's important to frame this to start with. So, look, I can't answer the questions on HEM at this point in time because the discussions have not progressed far enough. And we know the challenges when we're looking at real data versus the HEM measure based off the formula that was created by a university at the back end of ABS stats versus what the actual expenses are of a person and what frames as being discretionary spending and not. There are big questions and big discussions that are being had. I know ASIC's been looking at this for at least 12 plus months that I'm aware of, and we've had multiple discussions with them on this. And this thing's not going to be answered straight away, although it is coming up in the PC and the RC discussions. But the one thing that HEM revolves around, and where ASIC has been saying for the last few years we need to be, is that if we know a borrower's expenditure is far more than what the HEM measure is, we need to put that higher figure in. It has to be a truthful representative of their real circumstances. And I know the challenge for us in industry has been, well, we've done that, and then the lender says, well, no, our credit policy is that you've got to use the HEM, and so therefore we use the HEM, and that's the way it rolls. And now we have all these reviews, and people say, oh, yeah, you're a bunch of lies, you put the wrong figure in there, or we've been forced to by the lenders, not because we wanted to. So anyhow, those discussions are being had and framed properly to ensure that the understandings are correct. But in simple terms, HEM is about telling the truth. And we're going to see this in what's happening in the Royal Commission and things there that haven't rolled out that way. And this is all important in our regulatory environment. It should have always been, but it's a heightened focus on what the truth is in our marketplace today. So before we get on to more of that, in how that impacts through the Royal Commission, I guess we just briefly touch on the Productivity Commission. We've seen the final report. We expected it to look the way it did because the Productivity Commissioner was very blinkered on their approach. And we've all done our jumping up and down, screaming and kicking, and we've written more reports, and I'm actually just signing off on yet another report back on the Productivity Commission's review, as well as a final one for the Royal Commission tomorrow. Because the Productivity Commission's review, there is no sort of deadline or timeline where we can continue to make comment. And we've gone back further on it, trying to expand things. But the Productivity Commission is a really, really strange beast. And I'll just share with you a conversation just so I can put in context, because it explains everything on why things have come out the way they have. So if I go back 4 months ago, myself and a few other senior colleagues in the industry met with the Productivity Commissioner in Canberra. We sat there as a planned meeting with, there was 5 of us and 10 of them, if you like, and the discussion was that the chair, Harris, turned around and said to us from the Productivity Commission, she said, look, I know nothing about your industry, so what I need you to do is explain to me all about your industry so I understand it. So we spent an hour doing that. The good, the bad, the ugly, calling it the way it is, answering the questions on the way through, dealing with the issues of conflict of interest, commissions, etc., etc., etc. At the end of that hour, the Productivity Commission said, well, that's all well and good, but I actually think it's something else. I don't know what that something else is. I think it's something else. So we'll put that to one side when we move on, and we'll write our paper around what we think it might be. But we don't know what that is as yet. But he then said, don't worry about us writing a paper because we don't have to write a paper. We may not write a paper, but if we don't write a paper, then somebody else here probably will, and they'll get it wrong, so we will. And I'm sitting there going, yeah, but you don't even know what you're talking about. And then he caged the end of his conversation, well, even if we write a paper, 80% of what we write when we put it to government goes in the bin. So, it'll play out the way it is. I thought, geez, why the hell am I spending my time here? Certainly problematic. But that hopefully gives you a little understanding of the mindset of the things we have to deal with. They aren't interested in what we think. They're not interested in how we feel about things. All they're interested in is the fact that they believe they know more than us, and therefore they're going to do what they want anyway. So anyhow, we've done the journey there, and our final report will be in. It not only go to the Productivity Commission, it'll also go to the hands of the Treasurer and our new Minister, Stuart. I keep going to say Stuart Brown, and I haven't got my notes with me. And I think it's Stuart Robert. That's his name. He's so disengaged with the industry, I can't even remember his bloody name. So yeah, Stuart. I'm actually, funnily enough, I've got to fly from Brisbane to Melbourne tonight to actually have dinner with him. There's a very small gathering of about 15 of us meeting with the new minister, and we've been trying to reach out to him since he's taken office, and he's completely disengaged, which I'm very unhappy about. So it means the only way I'm going to catch him is in Melbourne tonight, and he and I are going to have a few words in regards to what's happening in the industry, and I have a pile of papers about 2 inches thick. I'm going to dump on him to make sure he understands clearly what's going on with our industry. But yeah, let's move on from that. The other piece then comes down to the Royal Commission. So following on from that HEM discussion, what we've seen in the Royal Commission is not necessarily that brokers are bad. It's not necessarily, and I have seen, from my review, no issues of serious or systemic breaches of complex risk or planning. What I've seen is constant breaches of 101 stupidity. So we have invoices or bills being sent out to dead people or to people where services haven't been paid, or we have mortgage documents being witnessed in blank or being given to people to take away and sign and then being brought back to the party and then being witnessed. We have banks lying to regulators. The conversation at the Royal Commission at the very early on in the piece here was talking to one of the banks saying, well, bank, do you know how many times you lied to the regulator? I mean, lying to the regulator is bad on a good day, but times? And the bank turned around and said, well, no, I don't. And the Royal Commission said, well, let me tell you, it was 20 times, or actually in excess of 20 times, that you lied to the regulator. Things like this are just dumb. But what they're doing is lying. They're not being truthful. And at the moment, the spotlight, and appropriately so, is being shone on the truth. And the only way you get to the truth is being transparent about what's going on. And the Royal Commission is treated like a court of law. That's why you've got an ex-High Court judge, Hayne, sitting in the chair, writing jurisdiction over this. And when you look at it online and you watch what's going on, it looks like a court of law. There's Queen's Counsels, QCs that are drilling the people who have done wrong as to the wheres and wherefores. And what they're trying to do is uncover the truth, get through, understand what the transparency piece looks like to find the truth. Because what has happened is, because that transparency hasn't been there, the truth hasn't been known, and therefore the trust has been dissolved. So the key to all this is understanding we need to be transparent with all the matters that we're undertaking so that we can uncover what the truth is or understand what the truth is, whether we like it or not, but know what that truth is so that we get the trust. And from an industry association point of view, we want people to trust us. We need to be transparent. From a broker point of view, you want your borrowers and your lenders to trust you, and therefore you must be completely transparent with the truth. Same with the banks. They must be completely transparent with the truth. And everybody will trust each other, and that's what we need to happen. And at the moment, that's not playing out so well in the banking sphere. And I know we're all worried about what's going to happen about our commissions going forward. And the Combined Industry Forum took a bit of a preemptive move on things to try and talk back to ASIC's position, which ASIC and Treasury are relatively happy about. Productivity Commission and Royal Commission, well, definitely the Productivity Commission wants to see things change, but they need a bit of an idiot anyhow by what we've seen. And with the Royal Commission, we hear a lot of media now. The reports are yet to come out. The draft report's out. We're responding to the draft report as we speak, and it will be finalised by me tomorrow and submitted. But we're actually approached this on a different basis to what most people are. And the reason for that is that we have some inside information that's beneficial to our journey. It turns out, and I didn't know this to start with, but it turns out the senior partner of the law firm that we use knows Hayne, the guy who was the High Court judge who's been running the Royal Commission, knows him, has dinner with him, thinks he's an absolute ratbag. I'd be more open with that comment, but, get where I'm at. He said he doesn't care. All he's interested in is the truth as per the law. So he's only interested in where the law states. So the fact that, people might lose their businesses and might send people to the wall, doesn't care. It's all a matter of law. The law says this is the way it goes. That's the only way it's going to be looked at. So many other people are writing their continual papers, and remembering we've all written multiple papers to both the Royal Commission and Private Commissions at this point in time. But our final paper, and we've done the dance on, the justification as to why things shouldn't change. But our response now is based on a principle of law. So we're arguing back, and when you're speaking to a High Court judge, the only person he's going to listen to is someone that he's going to respect. And not being disrespectful to our industry, but he doesn't give a rat's of what we write. He's interested in an argument that is based on a matter of fact, a matter of law. And so our final paper that's going in has been drafted by our attorneys who know him and also know one of the QCs that have been working at the front line of the Royal Commission. And we're writing back as principles of law, and we're arguing our position from that point. We also have certain pieces of inside information I really can't go into, but there are other areas and other issues that sit in the background that all support the fact that we're not going to have our industry destroyed as we come out the back end of this next year. Because we're not going to get to the end of this until next year. The final paper won't come out from the Royal Commission until February 2019. We'll be running into a federal election, and therefore we probably won't get decisions till the second half of the year. We may do. There's a strong likelihood we won't. But anyhow, regardless of that, we're putting in our final paper based on that principle and with other knowledge that we're confidentially aware of. I am still as convinced as I was when this journey first started with the review of brokers' commissions that trials will be there next week. You'll still be paid up front. Those things aren't going to change. They aren't going to disappear. Fee-for-service won't come in. And there still may be a little bit of tweaking we've got to do. Off the top of my head, I don't know what that would be. I think we're fairly safe where we are at the moment for this point in time, and nothing further needs to be done. But there's a whole host of reasons why going to a fee-for-service and losing upfronts and trials, or just even losing trials and only getting upfronts, today's model's not going to change. Well, certainly not dramatically, that's for sure, and nothing that will cripple the industry. Let's move on, because I can see I'm starting to run out of time, and I guess with all this stuff that's happening from regulation and from government and so on, I look at this and it's not about waiting for the storm to pass, because our regulatory intensity is not going to change. And in my head, what I've seen over the last 5 years, it's only going to continue to increase, which is good, I guess, keeps me in a job, but it's not going to change dynamically. So there's no point waiting for the storm to pass. It's all about learning to dance in the rain. And that's what we do, is keep dancing with these things, keep working these things, because they're not going to go away. We keep managing that process. And it's important to understand, because we've really got to get to this point of trust. And once we do that, we will re-establish the strength in our industry. And I see no reason why the broker market space can't be originating 70% of all home loans in this country. We're sitting around that 53 or just over 53% of markets of originations of home loans through brokers. But we need to make sure trust is right. We need to make sure the banks get this right. We need a strong banking environment. It's what got us through the GFC. But with this erosion of trust, it makes things very, very difficult. And we need to re-establish that. Banks need to be transparent with what the truth is, because once we understand what the truth is, then it will create the environment where we have trust. Because trust isn't given away, it's got to be earned. It's an important fact that we all need to remember. And hopefully we get to this sooner than later. And we all need to be on that way. I know the broking industry is. Because the reality is there's enough stress on our lives as it is with everything that's going on in the marketplace, which is why last year the FBAA took on behalf as being the ambassador for mental health in our industry. And it's important to understand that if you're not okay, that is okay. some lenders might like to think, he's a bit stressed or he's feeling depressed. That's a problem. It's not. We need to reach out to each other and look after each other. And I'll close on these final comments around stress and understanding why we've adopted the position of the advocates, of the ambassadors for mental health in our industry. Because when we look at the data of mental health in Australia, just around half of Australians at some point in time will suffer with a mental health problem. Right now, today, the data shows that it's 1 in 5. The industry professionals say it's more like 3 in 5 people today are suffering from some form of mental health, whether it be stress, depression, or worse. And the thing that's really the thorn in the claw is that every 3 hours, someone commits suicide from mental health challenges, and generally from severe depression. And that's just unacceptable. And I know last year 3 people in our industry who committed suicide from mental health, depression, severe depression. And we need to look after each other. We need to reach out to each other and make sure we're all doing okay. And in doing that, the FBAA has taken a position across 3 spokes in the wheel that says, well, we want to look after the industry health. We want to look after the physical health, business health, and mental health. Obviously, you can understand that mental health journey that I just spoke about. But with the physical health, you now can get discounts if you want to do Pilates, get the system going, keep yourself strong and healthy, help you to be more effective in business. We're looking after your business health by way of providing business coaching, be face-to-face now at our PD days, video series that are coming out, and, of course, have that conversation to make sure that a mate's okay. And all it is just being a friend. We're a large industry family. We need to look after one another. We need to keep in touch with one another and make sure we're doing all right. And in addition to that, and something a little bit separate if you like, there is a thing called the Sanity Space Foundation. That is a private charity that myself and my wife have established for parents and carers of special needs children and their mental health. And we're reaching out to everybody in the finance industry who may be a parent or carer of a special needs child to hook into the Sanity Space, have a look at the website, that we have closed groups in there, and connect with us, because I'm a stepfather to a special needs child, and I understand the issues and challenges that generally don't get talked about, because no disrespect to anyone listening, if you don't have a special needs child in your family, you actually don't understand the stresses that are on you. Janet and I have been together 8 years, and we've had one week's holiday in that entire time. We're lucky to get 3 days a year of 1 overnight breaks away from Charlotte. And she's a real handful. And what we want to do is to help parents and carers, because we understand the journey, help them out with their mental health as well. So our website has aggregated information services that are available. We're actually building a state-of-the-art search engine. It's not complete yet, but it'll be ready shortly, and that will enable easy access to information. We have support groups that are available through closed chat groups, so people can have that conversation that isn't judged by others. And as we go into next year, we'll also be providing financial hardship assistance. So if somebody can't afford a special wheelchair or prosthetic limb, or can't pay their electricity bill because they're going through financial hardship, the foundation will be able to gift them that money. Alternatively, if they've paid all those things, they can't pay their rent or their mortgage, the foundation will gift them 12 months worth of mortgage payments so that they can take the stress off their lives and think clearly about what their journey is in front of them. Because we can't change their future and what they have to go through. But at least if we can help them take a bit of stress off their lives, that's a good thing. It will help their mental health. So we're reaching out to the finance sector to say, hey, have a look at the Sanity Space, let's talk. But it also is a broader national initiative as well, because special needs impacts just under 1.2 million people in Australia, and that's on a direct basis, let alone the aunts, the uncles, and the indirect people that get involved as well. So if you know anyone, or if you are yourself a parent of special needs kid, please have a look at our website and have a look at our Facebook page. Details are coming up there. And if you miss them or if they move off the screen any quicker, let me know, and or get in touch with us, and we'll be able to give you the details. Let's move on. The last couple of things we'll touch on, and that is, if hopefully you've been out, hopefully you can come to our conference 16th of November, depending on where you are. It's a fantastic lineup of speakers this year, and it's going to be a great day, and the evening is going to be even more spectacular than last year for those that attended. And I look forward to being able to see you there and to have a chat. So hopefully you can make it. Well, that pretty much brings us to the end of the presentation. I want to thank you for your time. I do appreciate it. And I might just ask the boys here what questions we've got. I've got some questions here. And I will just talk to those just for a moment. If there's anybody else got questions, please just put them in the chat box area. So here's a couple here. So I've got one question about what's the point of the Productivity Commission and the FBAA's involvement. Well, yeah, it's something I actually ask myself at times, is what is the point of the Productivity Commission? It tends to be something that is a bit of a challenge, and they are looking at competition and productivity as such within the marketplace. But they have a very slanted view of the world. And as I said earlier, they tend to think they know more than anybody else. And that's a challenge. Honestly, it's a big challenge. And I was actually one of the first that actually spoke at the tribunal hearings that the PC had back 6 to 8 months ago now in defence of industry. And it's a very challenging conversation, but we're highly engaged with it and always have been. And so I'll go from there. I have another question as to what I expect from the outcome from tonight's meeting with the Financial Services Minister. And I guess the outcome that I'm hoping for is to, one, get him engaged with industry because he's not as disengaged, and two, to ensure that there is a transition of information. Back in 2013, when the government changed from Labor into Liberal, we had 4 financial services ministers in 2 years. That was one resetting every 6 months. And what happened was a lack of transition of knowledge and information between those parties. So again, we've spent the last few years with Kelly O'Dwyer, highly engaged there. She knew what was going on. Now we've transitioned into Stuart Robert. I am deeply concerned that the knowledge set hasn't been transitioned across. So I'm taking a stack of papers with me, and we're going to have a very succinct conversation around that. One last question, and then we'll look to sign off. A question I got here: is there light at the end of the tunnel into the trust in banks? Sorry, yes, in relation to the trust in banks. I believe there is. The banks, they've got their butts on fire at the moment. They're doing lots of things to get trust back into the marketplace. They're being in front of the parliamentary standing committees again over the last couple of weeks, being accountable under the FBAA regime, the Bank Executive Accountability Regime to government. They need that to be resolved. And the only concern there is that banks don't over-tighten the screws. And I do expect there may be a bit of that. And then what will happen, they'll get past it and things will loosen off again and will continue under the new norm. Anyhow, that's probably it from me. And I do thank you for your time. What I'm going to do is to hand back to John, our General Manager, John Purvis, and he'll just wrap things up for us. I really do appreciate your time. Thanks very much, everyone.
Yeah, thanks very much, Pete. Fantastic presentation. Once again, look, I'd like to thank everyone for attending this morning's webinar. We'll shortly be placing the recording of this presentation on our website for everyone that would like to visit, of course, fbaa.com.au. I'd also like to just remind everyone regards to the national conference. I know Pete had the screen up on the presentation before. SeaWorld on Friday the 16th of November. If you haven't already registered, once again, go to our website to find out more details. Thank you again for everyone attending today's presentation. We look forward to inviting you to more presentations shortly. Thank you very much.